So yeah, I was just gonna get started. So I have a plan for tonight. So we're looking at, first of all, we're looking at the weekend levels, the news that are about the news that is about to come the next week, and then the DXY, the SPX for background, and then the levels for Ethereum and BTC. Then we're gonna move into the weekly reflections, because these for past 4 weeks have been quite intense in terms of reflections on the technical strategy and how it's working in these times of consolidation. And I've made, both Roy and myself, we made some adjustments and some observations, and I think it's good to share them, just to, how can I say, they're open for discussion and they're open for application, where because the main point that I'm trying to get across is not to let the strategy be undermined by the moves of the market, because the market will be moving unpredictably. I think that's it. Yeah, in an unpredictable way. At all times, anything can happen. And what we have is a strategy that works more often than it doesn't. And when it works with the risk management that we are using, it's working with great profits. So that's the main conclusion that I wanna convey. But I've made some weekly reflections that I think are worth, in terms of the next time we'll go through this. I hope not very soon. We'll have the lesson learned, so to say. And last but not least, we have the previous bear market behavior for BTC, because again, what happens to BTC will happen across the board for all coins, and I think it's really good for us to have an analysis and see how the previous bear market exit happened, in terms of what are the moves that we need to see to confirm a previous bear market exit. So these are the three main points. I think we'll be here for about an hour and a half. Might be quite a lengthy session. It depends on how much I waffle. I don't think I'm gonna waffle too much though, because it's earlier, so usually waffling is a symptom of tiredness. Anyways, so we're gonna start with first the news. For tomorrow, it looks like we're gonna have a relatively quiet day, and relatively quiet Fridays mean sideways, and if we finish with sideways, we're probably gonna continue with sideways into the weekend and on Monday. So quiet Fridays, quiet weekends, quiet Mondays. We might have some choppy sideways, worth trading on the 15-minute chart because of the range, and we're going to see the range in more detail when we move into the levels. But generally, it's going to be quiet. So if Friday is quiet, I believe that it's going to be quite okay in terms of moves. No more super high volatility and spikes. Now, next week on Tuesday, we have news coming out from the pound, the British pound, and the Canadian dollar, and also the US in terms of flash services PMI. Why is this relevant? Because this is going to probably have an impact on the DXY, and the DXY will have an impact on the coins. Now, what happened yesterday, clearly market manipulation, the market makers moving the market, they all moved in the same direction. The DXY, the S&P, and the coins, they all moved in the same direction, which is not normally the norm, but that's where it happens to be pattern interrupt. Then we have, on Tuesday, FOMC meeting minutes, 7 p.m. We know what that means. That is probably going to lead to some extra volatility. it's scheduled 8 times per year, so very special monthly move coming on February the 22nd, Wednesday. We know also Wednesdays are generally high volatility days because especially with the FOMC, there's a shift over from the previous trend. For instance, if on Monday and Tuesday the trend has been down, Wednesday puts another leg down and then reverses to the upside. That's generally what happens on FOMC or other economic data. It's simplified, very, very, very simplified. I will show you in the weekly reflections what I mean more by the CPI reading that we had in greater detail. So Tuesday, some news. Wednesday, bigger news. Thursday, the GDP, the preliminary GDP, again, quite big, 1:30, middle of the day, an hour before the market opens. This will likely have an impact. It's released every 3 months. And Friday, core PCE price index. So we will have an eventful week as well next week, and we could how can I say, depending on the levels that we're in, we can use this volatility to our advantage. And in the weekly reflections, I will point out how to use this volatility, how can I say, in a technical way. So it's we want volatility as traders. This is a good situation to trade in. What we mustn't do is react to it. We must wait in a technically prepared way for that volatility to kick in. And if it goes our way, the way we've technically planned, happy days, we're following it. If it doesn't, we need to wait for the move to finish, retrace, and then follow it up. Or let the whole move finish and then wait for the next 4-hour or a 12-hour move, depending on the time frame. So in short, we are gonna have some events next week. I will be telling you about them and posting them step by step. They will be part of the pattern and the levels. Again, that's one of my weekly reflections. Levels will play out as they do. So we need to trust our TA if we're trading, and we need to make sure we're securing our positions with proper risk management, but also following the levels. Anyways, I don't think there will be too much market manipulation in terms of unusual moves like this week. A 10% move in a day does not happen very often. They made a big move Tuesday, Wednesday, even today they pushed a little higher. By they, I mean the market makers. That doesn't happen very often. That's not the norm. It's made repeatedly by the rule of 3, 1 to 3 days going up, so that psychologically we think, oh, it's gonna happen again. They're gonna move it again, and that's how they collect orders. Again, by they I mean the market makers. Okay, now so we have news coming next week. Volatility, it will play out within the patterns that we're going to map out. If there's something outside of our patterns, we'll let it play out, and then we see what we can do. Technically, what our signals are after the move is done. That's the strategic and technical way of responding to this, not reacting to this. Now, here we are with the S&P. We haven't finished yet, so yeah, that's it. We're having a session while the New York market, I think it's our first session while the New York market is still playing out. Yes. So we haven't closed yet, and at the moment we are having a stochastic momentum on the daily turned up, but we are an hour and 30 minutes from closing the S&P. We haven't put in a higher high. Yesterday we didn't put in a higher high. We're closing above the support and resistance level at 41, about 4100, but we're not putting in higher highs. Now this can only last so long before it's getting exhausted. And by getting exhausted, I am talking about the smaller time frames, like the 4 hour. The 4 hour is barely hanging in there along the midline of the Bollinger, which is the 20 MA, which is curved at the moment, and the stochastic on the 4 hour is down at the moment in crossing. The blue line is heading up, but it hasn't reversed yet to the upside. So that's what I mean by, if we don't put in a strong peak here and go above the previous daily high, we're likely going to have a downturn on the 4 hour, which could turn the day. On the 1 week, we are looking at the stochastic topping out. It's turned a little bit in preparation. It looks like it's curved in preparation for a turn down, but it still hasn't turned down yet. So we don't have that confirmation, but we have reached the top of the Bollinger. And once we reach the top of the Bollinger, we can either continue by putting in higher highs the way we've done so here in the bull market, or if we don't manage to put in a higher high on the daily, I think we might actually start turning down. And we do have pivot candles here. We have a swivel candle here. We have the swivel candle here. What we don't have is a down candle. So a down candle would mean a downswing like this one here, which led to a 0.5 correction. We don't have a down candle yet. We don't have a lower low. We don't have a higher high on the weekly, but we don't have a lower low either. So the S&P is stagnating. For the past 3 weeks, the S&P has been stagnating. I know it looks where we seem to be putting a different image on the daily. Let me go back because this is a good idea. It's so as you can see, for the past 3 weeks, the weekly has been stagnating here, doing higher lows but also lower highs, whereas on the daily it might look like, yes, it's holding support, but if we're correlating it to the weekly image, we can see that it's slightly turning into an M formation as is. What we do need for the confirmation of the M formation is the breaking of the neckline here at 40.60.62, which would be the breaking of the 20 MA on the daily. Now, keeping the idea in mind that the S&P has been stagnating to the upside for the weekly, I want us to have a look at what the DXY has been doing on the weekly. Because again, the DXY is looking scary on the daily. It's looking like it's barely holding support here. It is holding support, but it's looking like it's barely holding support. It's topping out. It's going to turn down. Whereas on the weekly, it's putting up candles, higher lows and higher highs, holding support on the weekly. So, and also the stochastic on the weekly has turned up for the DXY. Like, look where it's coming from, this dark place here at the bottom. So I wanted to make a mindfulness joke, having learned its lesson. So it's coming from all this oversold place and back up on the support line, higher highs, higher lows, looking like it wants to lift. Of course, it needs to meet and hold some daily levels with more conviction. So this purple area here of support and resistance should be turned back into support. It's been support here, broke it, resistance, it didn't even get to here, tested resistance, came down lower. Now this line, which is an intermediary line, has been turned into support, and it looks like the purple area will be tested again, which is the 105.22 area. I don't keep in mind these numbers, that's why I'm very visual. So that's why, and also that's why I don't avoid. That's why I don't say them, because again, it's not the numbers, it's the place in the pattern that's more relevant to me. It's good to keep in mind the numbers when you're in a trade, for instance, on a coin, and you're checking quickly on your phone. Now, I'm not saying that numbers are not important. I'm just saying why I just say purple area and not the number. Anyways, back to the topic. The DXY has shown a pattern of lifting on the weekly, whereas the S&P has shown a pattern of stagnation at the top. That is generally a sign of reversal for the DXY to the upside, which would mean the DXY is going to come down and the coins are going to come down as well. Crypto is going to come down as well. So we need to see in the next week how this rally is going to behave, because we will be looking at this rally as a possible lift out of the bear market, and we're going to analyze and see what we need for this lift to be confirmed, both in terms of validation and invalidation. And then depending on the global context, this needs to be sustainable. So even in times of recession, money still moves, liquidity still moves, the market still moves. It wouldn't be exceptional to have assets like stocks and crypto lifting while the world is in a recession, even though the EU has clearly stated that the zone will be avoiding recession. And again, the US is avoiding calling it a recession too. So even if they do call it, even if we go through it, it wouldn't be exceptional to have the assets lifting. There are still companies doing well, and there are still groups of assets that are doing well in terms of investment and value. So that's again the setup between the S&P and the DXY could indicate, to my mind, I'm 80% bear rally is over or close to being finished. We're gonna come down at least for a double bottom, if not a third leg down. I am more for a third leg down. Not necessarily in this 4-hour swing. There could be some more 4-hour movement, but for this swing. Okay, so that's the DXY, that's the S&P. Let's have a look at ETH and where we are on the weekly levels. I will be using again the daily levels as my guideline, because the move is on the daily levels. It's a 4-hour move, but it's on the daily levels. And I will be taking the space between, I think it's quite similar to last week's. I removed last week's, but I think it's the same. It's the space between the next technical target, the next measured technical target at 1780, 1790, and the 55 on the daily. And now, to be more conservative, because I've been more generous over the past weekends, and I've left a lot of meat on that level bone, I will place the 20 EMA on the daily as resistance rather than the 55, because it would be a huge weekend range in terms of percentages. Not excluded though, like if they wanted to liquidate a lot of longs, the market makers that is, they could go for 15, 12. So here we are, and the range would be 12%, very nicely tradable up and down. Now, again, this is part of my weekly reflections. I will say it to you now. It would require the same attention as this consolidation trading on the 15-minute, because the 1 hour doesn't give you enough signals. Not even the 15-minute will give you signals right now because of the level of manipulation. And I call this sclerotic, like it's whales pumping volume in and out, a bit like a blood vessel that's lost its elasticity. So in places it goes too loose, in other places it's too tight. So there's an irregular movement, so that throws off our signals, and that's why it's so tough on the 1 hour to be identifying signals. But on the 15-minute, the stochastic could give us clues, and we could trade it. If that's what you choose to do, I wouldn't do it. I would wait for the 4 hour move, which is what I'm doing now. Now, that would be ETH's range between the 20 EMA on the daily and the top of the technical target here at 1790. And I'm not going to make any adjustments to the structures that we have because it's the same structures that we've been in. Here we are on the 4 hour, having reached the top of the range. No panic here, because if this is the top of the 4 hour range, we will be getting something along these lines a lot. This gives us an 0618 retracement a couple of times, once, twice, 3 times. I don't even need to put the fib on it because I can see it. I will though, now that I say it. It's better to double check. So from here to here, I know this is 1703. I always tell you, okay, this would knock us out because it's bigger than $10. This one here wouldn't knock us out. And does it give us an 0618? No, this one gives us a 05, but this one here gives us an 0618. Yeah, there it is. And I believe also this one is a 05. Very good. This one here gives us an 0618. So an 0618 here, an 0618 here, and an 0618 here to catch the bottom of this channel. Because I believe right now we're gonna start moving. We're gonna be moving somewhere along this space. Again, I'm 80. I don't know what's gonna happen in the future, but I'm 80% moving sideways, coming and then coming down in this channel, and then for a fuller correction downwards. 20% breaking this line, heading up to 17. If I'm to take again the core consolidation here, placing it here, that would be huge. That would be 1900. The next level on the daily is 1790, right about here, which would be only one of these layers of the cake. No, that's higher still. I got it. Where did I get it from? I got it from the previous levels. Yes, I got it from these levels, from the levels that we have on from our horizontal levels, not these levels, not our vertical ones. So 1800 would be the next level of the next technical target of this consolidation. And again, I know I'm quite conservative with the targets, but I'd rather have them hit than missed. Here would be a bigger consolidation, a bigger channel, and it would have 1820 as an intermediary level and 1920 as the top level. Now this would be the least likely move for ETH. I believe that we're going to see some sideways, and then heading down, and again very technically breaking through these levels. And this would be a gorgeous trade to make, and it would be very nice and juicy, 13%. But I believe this is actually going to break down and do a correction of the swing, which I know ETH has done a bigger correction with Bitcoin. I think ETH did a 382, yeah, close to 382. But I want to see 382. No, because now we're resetting. So 382 was here. Now we're resetting because this one was higher. Yeah, slightly higher. So we need to reset. So this swing hasn't had its correction yet. Yeah, it took a while for ETH, because before, when I was preparing the session, it hadn't had the higher high. Anyways, back to levels. So this is what I believe will happen, at least down to this channel, because we're looking at the number of swings. And even if I am to take the first swing into account, one swing, one touch to the top, one touch to the bottom, up, down, we might see up, down till the end of the month. Maybe yes, maybe not. It is a range that's worth trading though. So that's the rest of our TA stays the same. It's very annoying because I love TA and I love to see a dynamic TA, but here we are in this sideways for more than a month now. It is what it is. It is a ranging market still. The fact that we made a higher high, and I'll tell you. So ranging for a month to make a 3.4 increase from the previous high is not a bullish momentum. It's not a markup phase. And when I say it like that, I say it more to myself to understand what's going on, because there are voices saying, in my head, there are voices saying, oh, maybe it is a markup, maybe we are coming out, maybe the momentum is changing. Well, if the momentum were changing, we wouldn't be spending a month consolidating for a 3% lift. I know this was a big move, but that's because it's made to, I believe it's made to manipulate the market and make it seem explosive. But from the previous high, which was in on the 13th of January, not this one, the first high of the swing, it's a 5% move. So 5% move after a consolidation of a month is very little, and it's made to look explosive because in the space of 2 days we moved 18%. We moved across these levels. So what happened, in my opinion, was there were a lot of people shorting here after 1, 2, 3, 4. I was liquidated previously in a move like this back in April, I believe, April or May, I think. And technically I couldn't coming from Eastern Europe, technically I'm very good at self-deprecation and punishing myself for, making mistakes, which is perfectly normal and human. But anyways, regional jokes aside, this move liquidated even 5% leverage traders in its strength. So a lot of the shorts paid for this lift to happen. So it's made to look explosive. We could have traded this. Personally, I'm not a fan of jumping in on trades like this, and I didn't jump in and I let it go, and I actually believe I made the right choice. because I don't think we should be reacting to moves like this. In moves like this, if we're looking at the impulse wave, the 1, 2, 3, 4, 5, the market makers are out in wave 5. Generally, they take their profits in wave 3, and then the final part is retail. I think here it was. I don't read the glass node, but to me, I think this was based on the vector candle moves. Let me show you the vector candle moves. This was a market maker manipulation move. Like, look at here, market maker buy, 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 buy. Big volume buys, bearish divergences across the board, even on the 1 hour. So again, I believe that was the market maker pushing liquidity into the market to collect the liquidity from the shorts. Because if you had the money to move the market like that and collect liquidity from liquidations and stop losses, you would do it too. And that's what they did. Plus, they're collecting orders, long orders, which I believe they're going to liquidate on the way down because everybody's expecting the next level up. Again, that's how I would move the market. I know it makes sense to me. It might make sense to you as well. Again, we don't know what's going to happen. The support is being held on the 4 hour. That's why I'm saying, could we continue to go up? Absolutely, we could. Do I believe so? No, I don't. And I don't think I'm the only one that thinks this is going to come to an end. Okay, now I started with ETH. I'll put that on Michael, so it's because Michael's here. So that's ETH, and I will be putting up these levels on the Discord tomorrow. But I think you have them already in the TA. Okay. Okay. So now for BTC we have similar levels, and again I will be quite generous. Look at the beautiful liquidity here that they collected today at 25, 1, 5, 0, 25, 2. Here they did it, 1, 2, 3, 4, 5, there it is, a beautiful lift, and again it's been made so explosive over 3 days, moved 16%, wow, 17%, boom, amazing, everybody's piling in Bitcoin to 56k. Headlines are saying, might be, it might be. However, we haven't even tested the 55 on the daily for that to happen. I will show you what I mean in the previous bear market analysis. I believe that this is going to be our level for the weekend. We might go up a little bit higher, up to my next target was, oh my goodness, here I am. Now let me quickly rename this. I don't think this is a channel. Okay. Do you know what? I'm gonna save it like this because I don't want to lose all of this. I'll tell you later what was going on. I have a target of 26.6. There we go. So if this consolidation in this area, the final segment, plays out, we have another lift at 26.6. If the bigger channel plays out, we are in for a chunky move, probably going to be testing the peak formation support and resistance. Leading up to 28.4, so that would be it for the larger space. So I'll only put 26.5 as a there we go. And I think I have 26.5 on the left as well, more or less. Okay. But that's the level that that's the level if we're taking this space as well as consolidation, we place it here, but that's the target that's already been reached. Okay, so I'll remove it. So between 26.5, it could still lift up a little bit higher from where it is now. I don't believe it will. Like, look at how they look almost identical, Bitcoin and Ethereum, in terms of patterns on the 4-hour, smashingly similar. Again, I believe we're going to see something along these lines, and Bitcoin is more generous in terms of retracement. If we're putting a fib from here to here, we would be knocked out there. I remember I was actually knocked out there. It gave me it, but it knocked me out there. But this didn't knock me out. I survived this. 800. Yes. No, I didn't survive that either. I survived this one. I remember I did a short here that knocked me out because these were higher highs. Where was it? Ah, it was this one here. Yeah, I got knocked out twice and entered once here, and I took a profit somewhere around here. So one of them I was sleeping for it. This one was sleeping for this one. This one was okay, but this one knocked me out. Okay, so but there are at $100 above the peak formation, we have a golden pocket here. I believe this one here offers us a golden pocket as well. Yes, a golden pocket right here. This one here offers us a golden pocket too. Now, mind you, I'm putting them on the 4-hour. On the 1-hour, they would be more similar. So we would have golden pocket here to catch it on the way down and not be challenged by our stop loss range. So this is what I believe might happen tomorrow and the weekend, based on the rhythm of the weekend. Then we might see another push up at the weekend, maybe another peak like this, maybe a slightly higher high, and then coming down and breaking these levels. So what did I say for the daily? The 20 EMA at 22.6 for the back test, and then 26.6. Again, if you're trading on the 15-minute, you could catch some stochastic swings to the upside and to the downside, because it is 16%. So it's a generous enough range to be trading on the 15-minute. Now, we've done the levels. We're done with the levels. Let's have a look at my weekly reflections. So I have the first reflection that I've already shared with you. Made a short video about the FRVP levels, which I've been using this week in this sideways. So technically they have been such a revelation, such a nice addition to my TA, because they are confirming the direction quite early on. Now this week I've given them a proper drive test through this messy sideways, and they were spot on. So I put them on the past 4 swings on the 12-hour. So I have them from, there we go. I have them from the top of the previous drop to the bottom, then this swing, and then this swing, and then this swing here, the 1-hour swing and the 4-hour swing, and they showed me step by step how And if we look back, we can see what happened here. We had two big levels of points of control, which were, again, I had these levels slightly lower than the points of control here, but it's great to see them confirmed twice by a volume correlating indicator as well. And then we had here in this messiness here on the 4 hour, once it crossed up, went up to here, seemed like it was getting rejected, crossed it, and there it is, up again to the top. So meeting the previous peak in this range. So here we are at that big 25k psychological level, and breaking it and consolidating and keeping it is a big thing for Bitcoin. And this is my first reflection for BTC. They're super. The thing is that we need to update them. I'm gonna look at the settings. I think Roy doesn't have to. I think he's adjust automatically, but I'll have to check. I will have to check that, and I will let you know. I've used them for Ethereum as well. I made a chart. Let me upload it here. It's called ETH FRVP. There it is. So again, super useful to map out. I think I have an extra level for Bitcoin. You can put them from as many time frames as possible. Don't again, maybe that's the minimalist in me speaking, don't make it too cluttered. And again, we can see how this was the W formation and then broke up and then went up and just broke through all of these levels, like, you know, like it was nothing. 20% in a couple of days. Absolutely smashing. I wish I had believed this more, but you know, it is what it is. At the end of the day, I need to follow the strategy and what it's giving me. And what was the misleading indicator for me in this one? Well, not misleading, but the one that, how can I say, the one that didn't react to this was the stochastic, the RSI, the momentum that was in the overbought, which again, it might have reacted, because if it's a market maker move, it's the way to react. It's just that it wasn't giving me signals to go in. Okay, anyways, so the first reflection is the use of the FRVP, great tool to double check the levels. The second one was what happened at the CPI. Now, the CPI is an event, but the events play out in the space of our patterns. And I will show you what happened with the XRP, because I was trading XRP and I was preparing for the CPI release on the XRP chart, and it's going to be easier for me to show you. So we were somewhere around here for the CPI. This is the Tuesday. Yes, this is the Tuesday morning, and here is the 1:30 when the CPI was announced. Now, I was in a short. I started a short at 32.02, and I had my stop loss at 37.02. I had my stop loss at 37.12. So I said, if it breaks the 37.12, it's gonna go to the upside. And So here was my entry for my short, and I was still in that short, but I thought it was gonna give me the correction down to 35.5 before it goes up. That was the rationale. Also because look at where the stochastic was when I entered that short. I really had the, there it is, the 1 hour. I had the stochastic 1 hour on my side, I had the pivot, and I had a couple of vectors there. So I had my yeses when I entered that short. I'm going to switch back to the 15-minute. I also hedged my position here because I knew that the CPI was going to be very volatile, so I said, okay, if I protected my stop loss, my position here with a tight stop loss. 10 points is 2.5%. But then I said, okay, if this is going to push up, it's going to give us first a retracement. It's going to give us a double bottom, and I'm going to put an entry at 36.55 as the 702 of this swing. So I put in a 36.55 entry with a 5% stop loss, and that 5% stop loss was right here at 36.36, and it knocked me out, that 5%. And of course, being knocked out, I said I'm gonna sit back and let this play out because I've already had my shot, I've tried it, I got knocked out. I need to see how this is gonna settle. And then I stepped back and I let it play out. And then when I realized it was gonna go up, I didn't follow it up because it didn't offer another 702. Also, I sort of like moved away from reacting to the charts because I know that volatility usually triggers me, and I want to I want to practice observing it more. Now, what was my reflection about this CPI? When the CPI day comes, there's going to be great volatility, and we need to do two things as traders. First, be prepared for it with some nice orders and secure our own profits if we are in profits in different positions, or secure the positions if we don't want to get into the red too much. Second, we need to, for instance here, this was a 4-hour move, this was a 4-hour play, this was the 4-hour. This one was the 4-hour W formation. That's what I went for when I put in that long here. But because it was a 4-hour move, it was way, how can I say, the volatility, the 5% stop loss was too little. So what I'm gonna do from now on CPI days, I'm gonna de-risk. I'm gonna start with half of my position, even if that even if that how can I say, even if that 5% covers the previous wick, I'm gonna start with half of my position just to make sure I cover the previous wick generously, because I don't want to get knocked out because of the volatility. So that was my reflection for that CPI day. With or without the CPI, we would have had this move. The CPI makes it happen faster. That's the only thing that they do, these moves. They make, market makers are great at making the moves the actor of the swings. But the swings, the moves are just, the news are just catalysts. They don't move the swings. The swings move, and they correct and retrace where they correct and retrace. They, again, they're just making us believe that, oh, it's the CPI that moved the market. It's not the CPI that moved the market. The market would have retraced there because the market had already reached here. on the 4-hour stochastic a point of oversold. I believe that, yeah, and I'm right here, the regular RSI reached as well. So it was a natural move for the market to make. Okay, now that was the second reflection. So for CPI days, to protect against the volatility, we can hedge a position the opposite way, which is what I did. I was in a short, but I said, what if it's gonna play out the 4-hour pattern rather than a deeper correction? It's gonna reverse. And I was trying to be smart there and use the volatility, and I almost made it. I didn't make it, but I almost made it, to be, perfectly honest with you, because I think there's a great lesson there for us to keep in mind. So if I had de-risked and went in with half my position, I would have covered more of the previous bottom, and that would have been that would have kept me in a great trade. I wouldn't have thought this is gonna happen, go all the way up to here. I would have probably taken my profit at 38.5. That was my initial target for that long. I wouldn't have thought that this is gonna just keep going. Just a second, let me just check this because I had an order in here. No, not yet. It's at 14.20.27. Not yet. Okay. Okie dokie. So that was the second reflection. I have 5 reflections for you guys. The third reflection is trusting the TA, trusting the levels. Because of how the market makers operate and how they move in these circumstances, I found it hard to trade the levels because of how fast this whole thing was moving. It wasn't range trade speed, it was impulsive trade speed. Like the moves were really, really quick. But if we're looking back on RTA, there was nothing that we would have missed, this wasn't a move that we would have missed if we had kept our eyes on the level. So next time, again, in times of sideways like this, levels, the 4-hour levels are super to trade. Now, you can choose one direction. Now, I chose shorting because we are in a bear market, and I believe this is a rally and this is going to come down. So I chose shorting in this consolidation, and I have my here were my shorts. Entry here because I had my 1 hour topped out here. I had the bear divergence. Entry here. Both of them got stop loss. I lost 10% here. I could have been liquidated twice here. So that's how important it is to keep a super tight stop loss in these situations, in this circumstance. So the 4-hour levels are like no guts, no glory. We need to see how they're holding, put a stop loss, start with a third or half of the position and follow it up to the next level, which is what we discussed last week as well. In the same reflection, the 15-minute time frame is great to give us indication if we are willing to follow it candle by candle as it happens. This was the 15-minute. So you can see that the 15-minute is giving us indications in the stochastic and in the bear divergences. The bear divergences here, not even on the 15-minute played out, so that's I take that back. But the stochastic here, the stochastic here, and the stochastic here shows us that there's more lift to go on the 15 minutes. So if you wanna trade that on the 15-minute, you could trade it, but it is quite tough to follow it step by step, candle by candle. It's very emotionally demanding, but because of where the market is right now, it could have been profitable. Now, I don't recommend it for a long time, because when the real move comes, you will be exhausted after all of this. So if we're looking at all of this play, that's the small fish to catch compared to the big correction of this swing that still hasn't happened yet, because we've put in a higher high. So this was 3, 4, 5. This will be the move down, which is going to be great, at least the 0.5 golden pocket, 702. So this is going to be the nice juicy bit, even if we are just going for a 0.5, that would be the 16%, a 10x 160%. So really nice numbers. Okay, now fourth reflection is about patience and not reacting to FOMO. Now these moves happen 20% in 3 days for a lift in these times. There's an energy crisis. There is a war in Europe. There are so many. There's an inverted curve on the bonds in the States. There are so many things happening, signaling a downturn for the market. And still we get a 20% rally for BTC over the 3 days. It's mad. It's mad. It's crazy. So staying patient, not reacting to FOMO, is a skill in itself. No position is a position as well, and it's really important to know that and not to react to what's happening, because sitting back and waiting for the move to finish is how can I say, it's the strategy. Is the strategy approach. Like, you are planning your next move. You're letting the current one play out. You're not in it. You're letting it play out. You're waiting for your signals, and then you're coming in when you have your yeses for your trade. And that leads me to my final reflection. If it takes courage to do a trade, that means it's the wrong trade to make, because you're not having your signals. So we shouldn't need courage. We should need our technical yeses. And that's why I chose to stay out, because I didn't have my technical yeses. And the point of this whole week's reflection was strategy comes before everything else, because it's the strategy that's proving the consistency of the trading, not the luck or the courage to make a move, because this is not based on luck and this is not based on courage. It's not good luck or good fortune or courage. No, it's strategy, and it's the mathematics of the strategy, the risk management versus profit. So if it takes 10% loss for Bitcoin and 10% loss for Bitcoin, and then 7.5 for XRP. These two were my stop losses. So minus 7.5 for XRP, minus 10% for Bitcoin, minus 17.5% this week. However, the move that I'm waiting for is at least a 10% move for XRP, at least a 10% move for Bitcoin. I'm not measuring, but you can see that for Bitcoin it's at least 16%, but just on average a 4-hour move, 10%, very conservative, 20%. So 200% minus 20%, that's still 1.8x profit. This is the mathematics, the winning mathematics of a 4-hour trade. And if it takes 4 tries or 5 tries to get into a 4-hour trade with at least a 10% profit, so be it. So that's my summary of the reflection. If you think it takes courage, or if you think it takes good luck to get into a trade, that means the technical signals are not there. So it's better to wait until you have those technical signals. Not reacting to FOMO is the strategic response to this. As frustrating as that might be, because it was very frustrating, and it is still frustrating with all this zigzag. But again, 20% move over 3 days. Something is very, very dubious. I am very suspicious of this move. Maybe it's my suspicious nature. Maybe we are leaving the bear market, or not. Okay, so these were my reflections. In short, the FRVP levels, brilliant. The preparing for the CPI with de-risking so that we allow a little bit more in the stop loss for volatility, but within the 4-hour pattern is one of the big things. Third, the 4-hour levels played out to a T. They played out a lot quicker than we expect them to, which is where the surprise element came in. And also the 15-minute time frame uses only one indicator, the stochastic, which makes this a very hard technically to read, period. And the last point was about staying with the frustration, not reacting to FOMO, and no position is a position as well. You don't need courage, you need your signals to put in a position. Okay, I'm sure you know most of these. I just think it's to me, to my mind at least, it's useful to have these clarified and repeated. Now, the last part of our talk tonight is bear markets. Having a look at Bitcoin's bear market and what it took to leave that bear market and move into a bull market. Now, I made a beautiful chart previously on Bitstamp. I saved it, and now it's still here. Yes, perfect. Okay, super duper, excellent. I didn't know I could do that, but great stuff. So, Bitcoin had, depending on how you see it, between 4 and 5 bear markets, has had 4 or 5 bear markets. 2011, 2015, 2017. Some people consider what happened here in 2021 a mini bear market because it led to a higher high. I personally don't consider this a bear market. I believe this is a correction. And then 2022. Now, I will take the I'll have a look at the 2015 and the 2017. The focus will be on the 2017 one because it's the most balanced one. This one here in 2020 was COVID, massive sell-off, panic sell, and then a lift-off. So this was actually part of the bull run. It was the first correction in the first major correction in this bull run. But again, I won't take this dip as a guideline because it is a pandemic. It happens once every 100 years. So again, it's not it didn't happen here in 2015, so I won't take that as the pattern. I will take what happened here as the lift off from the 2017. So I made a couple of notes about what we need to see before leaving the bear market and moving into the bull market. First, I'm going to start with a quick extension fib from the 2015 bottom to the previous top, so this being the swing low, the correction, just to see where this just to see again how the parabolic move happened. So this was the lift into the 2015 bull market, then the drop in 2015, and then it stayed there for about here January to August, 7 months, and then it started lifting, and it went to the 272 extension level here on the fib. 272, a little bit above it. Again, these levels are daily levels, but it's lovely to see how it went step by step through the fibs in the extension, just to have it in our minds when we go through this in the next bull run. And then I put the fib down for retracement to see how the correction happened in the 2017 bear market, and it was down to the 382 level. Now, if we're looking at how the descent into this bear market happened, is we had the peak formation here. Let me just make it big. I made notes because I want it to be super clear. So we had the levels. We had 3 steps down. We had the peak formation here with its neckline, broke the neckline, back tested, got rejected, back tested, got rejected. We put a target, we measure. I'm going to measure it down to here. Perfect. We put it down to here. Almost. Look, it's a matter of 6352, $400. So less than, I don't know, $400. Oh, it's so hard for me to calculate right now in percentages, but I will because I wanna. I'm not a perfectionist, I'm a completionist. 7%. So a little bit, 7% off from this target, but again, we are talking about a massive move down. So 7% is a sixth of the whole thing. So again, it was a 49% drop. So peak formation target, super close. You might wonder why there is this difference, because look, it's the 236 level of retracement. We take this target here and we put it down to here, and again down to a T, down to the 382. Here's step 3. M formation, level 2, level 3, consolidation on level 2, level 3, here we have a reverse head and shoulder. Looks so bad. Terrible throat. So here it is, a W or a reverse head and shoulders, because there are actually 3 peaks here and 3 drops, and then it reverses to the upside. So this is the beauty of the pattern, and this is why so many people are trading BTC, because of how regular and neat it is in its levels, its retracements, and it looks super clear to us. Now here at the bottom, it spent about 5 months here in the final stage. So this is it starts dropping in November, reaches by December, in a month it reaches level 3, and then in April it lifts. So about 5 months, 4 months in the final stage till reversal starts happening. And here we have reversal because we have the descent, we have a lower low, we have another lower low, and then we have a higher low. So we have this rounded bottom formation on the daily, but this is also a rounded bottom in swings. So we have 3 peaks. We don't have higher highs. Oh, sorry, this one here is a higher high. We don't have we only have one initial lower low. So we have a higher high at the end, and we have the initial lower low. So very irregular to trade, and very steady in levels. So what did we need for this bear market to be confirmed as an end? 1, 2, 3 stages. We needed a rounded bottom structure here, and we needed these levels broken. Where's the confirmation that we are out of the bear market? I believe that the earliest confirmation is here, because this is getting past the previous level rather than getting rejected, because if it were to get rejected, that means it would be coming down one more time for a lower low. Here it didn't. This is the earliest confirmation to me for the lift out of the bear market. This here would be the lift out of this bottom formation. That would be again a signal, but this signal would only mean that this line is going to get tested. When this line is the previous support and resistance, the major support and resistance for this, the 236 level on the daily retracement, when this is turned into support, then this is where the lift happens. And then not only did we get these 2 important lines turned into support, but this one didn't get back tested again, because this is not as important. This is just this level being this. Oh, I don't want to say too many these without showing you clearly what I mean. Let me change the, okay, I'm gonna make it red. So this consolidation led to this lift. If this lift had gotten rejected, we would have come down lower, but it didn't. It went up and back tested. And the key element of this is the back test. This, and it holds. So this whole thing turns into the W formation for the lift, and it takes us at least up to there. It didn't take us there straight away. It was quite sinewy, I think, winding. That's what I want to say. So plus a pandemic here in the middle, but we did eventually get there. And you see, this line wasn't in, it's not, we had so that you see, I really want to make this clear, because I want you to see why I'm so stubborn about back tests and corrections. It's not like you don't know yet, but just to be clear. if we're taking this swing here and we're putting it down here, here it is, the 0.5. Sure, this goes lower. This is actually at 786 because of the pandemic. That's the pandemic. That's, again, it's a pandemic. It's a once in a century event. But without the pandemic, excluding the pandemic, which was quite rapidly bought in that dip, we had a 0.5 correction and then continuation. So we had the back test, we had the correction. Now, to wrap it up in terms of what we need to see in our current market, we need to see the 3 levels down. We need to see the main level back tested, and then we need to see a correction. These are 3 things. You know how I like summarizing in 3 or 5 points, because I think that it's easy to remember a number like that. I think here that's what we need to see. We need to see the levels down, we need to see the back test, and then we need to see the correction. And here, this back test here, to me, it speaks volumes. This is the rally, but the rally turned into the lift. The rallies here were less proportionally. This one here was the biggest one. This one was smaller at the end. I don't know if this is a sign. We've yet to see. However, coming back to where we are, and I'm gonna try to minimize the image so that you see the two bear markets together. So this is one bear market, the 2017 one. This is the one that we're in. If I'm taking the levels, I'm taking this as the peak formation. This would be my peak formation. If I were to measure it, this would be level 2. Level 1, level 2, we need a level 3. However, if I take the fib retracement from the previous market to now, we've almost reached the 0.5, close to the 0.5, but not there yet. The 0.5 is 14,000. We are somewhere between the 382 and the 14,000. Could we have made a messier 3-step down descent? Yes. Yes, maybe that's the case. But what we need to see, let me put now some lines. Okay. Now what we need to see is this back test. So I believe that what happened here is accumulation for this lift. What we need to see is a move away, and I have 30K as my exit, and then a back test here, and then continuation. So if we are to break higher, we need to break the previous support and resistance, and we haven't done so yet. This would be here where it happened, and it happened with a that is hefty, 33% lift in the space of a week, I think. Yeah, it's less than 7 days. And altogether from here back to the back test here, it was 150%. At the moment, what we have from the bottom here to here, we have 45%, so a third of that strength. Not that it wouldn't happen, it could happen if we lift up, but again, the percentage doesn't matter. It's the support and resistance levels that we need to see. So maybe this is the how can I say it? Maybe this is the swing that will carry us up to 30k and then consolidate and then lift up. But we haven't seen that. So even if I am to say my levels might not be clear and maybe we have done the 3 levels down, okay, I'll have one yes. But then I don't have this level and then I don't have the correction. Here we had the back test, the lift continued and then corrected and then lifted some more. So that's the proper lift out of the bear market. It's not as easy as YouTubers make it seem. Yes, there are some psychological levels. I think 25k is a big one. I think 30k is a big one. Once we break the 25, we need to break the 30, back test the 25, and then continue upwards. And then when we continue upwards, we need to correct first before breaking higher highs. So before reaching 50k, because where was it? Yeah, so or thereabouts, because here it broke the previous level. So breaking 50k, we need to correct and then continue. That would be our level of resistance here. The way 10,000 was here and then it reached 13,000. So that's what happened there. It corrected because there was some selling pressure there. People who bought in here and then waited it all out and then saw it here at 13k, made a little bit of profit descent, maybe bought back in if they were smart or resilient enough, and then continued to lift. Anyways, these are the 3 things that I see in terms of technical analysis of what we need to see compared to the 2017 bear market. So we need to see the 3 levels down. We need to see the lift breaking the resistance of the previous level, back testing it, and then that lift correcting before moving forwards. We need to see that. I believe that right now we are actually, I know I keep saying this and don't want to repeat myself. I think what we had here in the second stage looks more similar to what we're having here, but it just looks, because we're getting at the moment lower highs at the moment, like this 20. No, this one tipped it with a little bit higher. Anyways, I don't personally see the 3 steps down. I see 2 steps down. Could this be tinier? Could we have? This would be too small for an M formation. This one would be more reasonable here, but then where is the? These are too much into the peak formation. To me, this is the M. Come on. This is the M formation. Anyways, that's what I had to tell you. That's what I had to show you tonight. So I know it's been a long session. Thank you for your patience. You can also If you have any questions or any observations, of course, about any of the parts, chat to me in the Discord. Just as a summary, I believe that this rally is close to finishing. Could we still have a minimal higher high or around 26.6, maybe even 27, 28, maybe? I don't think so based on the local 4-hour setup. I don't think so. But we have a whole weekend and Monday to see where this is going to take us. This needs to continue. Like, if this is one of these beautiful lifts, this needs to continue. Needs to keep going and break through the daily support and resistance. And at the moment, if it stops, then we have our answer. If it keeps going, we have our answer too, but we need some more confirmations. Of course, once the daily stochastic is up and it stays up, and then we have the 4-hour correcting to the downside, then I'll be looking to go into longs. At the moment, I won't be looking. I know I sound like a total perma bear, but as long as the 4-hour stochastic and the RSIs are like this, the technical choice for me is to short. I won't be too rushed to short yet. I'll be putting in a range once this 1 hour finishes for an 0618 retracement for BTC, so up to here, and that would be a beautiful head and shoulders formation, maybe just in my imagination, and then start coming down. So that's what I'm looking for. Until then, until I have a nice entry with my technical signals in line, I won't be looking too long. I'm not FOMOing in until we have an official bull market. When we have an official bull market, that's going to keep going 3 years. Here are back to the timeline. So 2017 to 2021, 4 years. 2 dips here, but they were bought quite quickly. Same here, 2015 is the lift from the bear market, and it continues to 2018. So I have 3 years after that too long. Until then, I'll be shorting because I believe there's another leg coming down. That's it. Thank you again for listening. Have a beautiful evening, and I'll see you tomorrow in the chats. I'll be posting the levels tomorrow morning because now my eyes are ready for sleep. And if you guys have any questions, do let me know.